On April 20th, 2020, something happened in the oil market that had never happened before. Oil prices went below zero. It sounds impossible, but it really happened. To understand why, we have to go back to the beginning of the COVID-19 pandemic. As the virus spread across the world, governments shut down cities, airports closed, flights were canceled, and millions of people suddenly stopped driving to work. Global demand for oil collapsed almost overnight. Normally, the world consumes around 100 million barrels of oil every day. But during the lockdowns, that demand dropped sharply. Highways were empty. Planes were grounded. Factories slowed down. But there was another problem. Oil production didn't stop. Major producers like Saudi Arabia and Russia were still pumping huge amounts of oil out of the ground. Oil wells can't simply be turned off instantly. So supply kept flowing while demand was collapsing. Very quickly, storage tanks around the world started filling up. Now enter the futures market. Many traders weren't buying oil because they wanted physical barrels. They were trading futures contracts. But when those contracts were about to expire, traders holding them were suddenly required to take delivery of real oil, and there was nowhere left to store it. Panic began. Traders rushed to sell their contracts at any price. Just to avoid receiving the oil, prices fell rapidly until they crossed zero. On that day, West Texas Intermediate crude oil fell to negative $37 per barrel. For the first time in history, sellers were literally paying buyers to take oil away. It was a powerful reminder of how markets really work. When supply keeps rising and demand suddenly disappears, even the most valuable commodities can collapse.